This is Lynn with Leaders in Lending, and happy to be joined by Joseph Mayans, who's the chief economist for Experian here on the podcast today. Thanks for being with us, Joseph.
Lynn, thank you so much for having me. This is actually my first big time podcast I've been part of.
Well, good. Well, we're very glad you could be here, especially at CBA Live, knowing that you presented earlier. So you've had a busy day. If you could tell me and our listeners about yourself, about your role at Experian, and about your background, kind of what led you to being an economist.
Yeah, I'm the chief economist for Experian North America. We also have great economic teams in the UK and Brazil. But really how I landed here, so just quick background. So my undergrad is in philosophy, and I actually got interested in economics. I used to day trade all the time in the library while studying. Yeah. I made money, lost money. And I was like, I need to really kind of fundamentally understand what's happening here. And so that's when I got my master's in econ, just fell in love with the discipline. And then I went on and did banking policy for the U.S. Senate. So I was out here for D.C. for a while. And then went to Salt Lake, was an economist out there for a large regional bank. Then I started my own economic consultancy company. And then I started working with Experian in that way. And then now I'm in-house with Experian. I spend majority of my time, about 70% of my time, working with financial institutions all around the country. So I think I did my end of year tally. I think I spoke to over 100 organizations last year, from the kind of the largest financial institutions all the way down to community banks, credit unions, fintechs. It's just awesome.
Well, that's interesting. I'm sure you travel quite a bit then, probably, to see all of those clients, and probably a good exchange of ideas too, kind of hearing what's happening nationally, but then also regionally and locally what's happening.
It's fascinating because each segment of the market is really, and they've reacted to the market, the environment we've been in the last several years, differently. Each has its own unique challenges, and it's very fascinating to get the different perspective. The other thing that, one of the biggest things, this is a relatively new role at Experian, and one of the things I've been focused on is there's so much data within the company. Not only do you have the consumer credit data, commercial credit data, you have rent bureau data, housing market data, consumer spending data. But part of it, as an economist, it's like being a kid in a candy shop. It's how do you bring all these pieces together to kind of give a richer view of the economy that you need elsewhere.
Sure. Well, I think it's hard to believe that we're really almost at the end of Q1. So as we think about looking ahead to 2024, we're already partway through it. But what are you thinking, or what are you seeing as kind of some of the key factors or indicators that are shaping your outlook? And then also what is your outlook for the rest of the year?
Yeah, I think it's really interesting. I spoke last year here at CBA Live, and the sentiment was very different. It was right during the regional bank crisis.
Sure.
We had a couple of bank failures by that point. Concern was definitely in the air. If you look back in 2023, much more the sentiment out on the street among economists, among bankers, where recession was on the horizon.
Sure.
Right? If you look at where we are now, I think everybody, I just spoke to a room full of bankers. Everybody has been very surprised at the resiliency. And so what you've seen is economic growth has outperformed expectations really again and again over the last year. But when I look forward, I see the economic growth continuing. I think if you look at the Federal Reserve just put out their latest forecast and increased the path of growth for 2024. Our internal forecast again show a solid year of growth. So our view is not recessionary this year. We have a solid growth picture, but I think there's always risks on the horizon to think about.
What are some of the, biggest indicators to you then? I think you mentioned earlier just the volume of data out there, and I know I worked in investments for a long time and did a lot of due diligence on some of the high frequency traders who use a significant amount of data. So there's almost an endless amount of data points you could look at. But to you, what are some of your top indicators, either leading or lagging indicators that you're looking at in your work to come to that kind of assessment of recession likelihood?
Yeah, for sure. So, the thing I'm most interested at the moment, I think has been the biggest driver of our growth, and probably the most surprising thing, is the resiliency of the labor market. So if you look back over the last 3 months, we're adding on average 260,000 jobs a month. Prior to the pandemic, where we also had a very low unemployment rate, 3.5%, 3.7%, we were adding about 180,000 So we're adding a lot of jobs every month. Unemployment overall remains very low. And so when you think about the economy, consumer spending drives 2/3 of growth. That's where kind of that drive has been, and I see continued growth this year. And so to that as well, consumer spending has been strong, has been stronger than I think many economists would have expected at this point. So
Do you think maybe we're seeing too much growth? Like, do you think there should be a little bit of a pullback, or are you more kind of reacting to what you're seeing versus necessarily have an opinion on where it should go?
no, I don't think we need to see a significant slowdown. There was a question earlier last year. Will the unemployment rate need to rise materially so the economy slows, so inflation slows? And I think the answer is no. You've seen inflation make pretty significant progress over the last year. May not be exactly where the Fed wants to see. Inflation has picked up a little bit in recent months, but overall it's moving in the right direction. And I don't think you need to see a big slowdown or change of growth. I think we're growing at a good rate.
Okay. And you mentioned the Fed's forecast for 2024, and what are your expectations? And maybe kind of share with our listeners like what the Fed is saying, and then what you and your role at Experian are thinking about interest rate changes, really just over the year. I think farther than that out, it gets a little bit harder to go past.
You're exactly right. After a year, that's pretty difficult. But I would say there's been a shift in the market. In December, the Fed had put out the previous forecast where they expected 3 interest rate cuts this year. And immediately, market participants started pricing in 6, maybe 7 rate cuts this year, which was I think way too many. Market got ahead of itself there.
Sure.
And what you've seen in the latest meeting when the Federal Reserve just met and released their latest projections, again they reiterated 3 rate cuts this year. And that to me again feels right. I think it's going to be pretty close. Whether maybe they do 3 or maybe do 2, I still feel 3 is the right path. And I still think it's probably roughly a coin flip at this time, but I think they cut in June. Yeah, I think they cut in September, and I think they cut December. And that allows the Fed to basically cut, wait a meeting, cut, wait a meeting, cut. They can take a more cautious approach that way. And at those meetings, it also allows them to, they release their forecast so they can provide more context to their overall view. In terms of financial institutions, that first rate cut is going to send, I think, a signal to the market that the Fed is now going to be moving into this more of an easing cycle, at least not keep rates so restrictive.
Sure.
And that has all kinds of implications. If you look at the challenges financial institutions have had with deposit costs, right? Especially after the regional bank crisis, there was a big challenge to retain, get deposits. You never want to be seen, especially on, the market is having any challenges there. And also deposit costs, obviously, as rates come down, it helps with consumer demand for lending and things like that.
Sure. Yeah. And we definitely spend a lot of time talking about when the bank failures happen, like the worry about the contagion. Is it just going to get worse? And sometimes I think it self-perpetuates, where it becomes if consumers believe it, if enough people believe it, it will kind of manifest itself. So it's I think it was relieving to all of us to see that not come true, and to those be a little bit more kind of localized to a few institutions. Certainly with rates kind of being and staying high for consumer lending, as you think about just credit growth in the market right now, that I think demand for loans is a little bit less, and we're certainly seeing that in the personal loan market because rates are high, and so people are not borrowing. What are your thoughts about kind of just overall credit growth, whether consumer or commercial, availability of credit, and where you might start seeing some kind of stronger growth areas out there?
So I think for me, it's the most interesting dynamic that's played out over the last year is that you had really a very strong economy. You had a really good labor market, you had good spending, and yet credit growth has slowed quite significantly over the last year. And so what I'm watching going forward, it slowed for a couple of reasons, and it's what I'm watching, is that number one is recession concerns, right?
Sure.
Especially after the regional bank crisis, everybody's concerned about potential for a recession. Last year, even though the economy was good, people were just waiting for the next shoe to drop. And when you have that, institutions are much more cautious on what they do on their investment, their lending. But the other thing you had was you had delinquencies beginning to rise. And as delinquencies rise, institutions tighten their lending standards, they increase their lending standards, and that reduces the supply of credit.
Okay.
So that's going to slow growth. And then you had interest rates, which remained high, and that slows the demand for credit. So you had recession concerns, you had reduced supply of credit, and reduced demand for credit. And so what I'm looking for this year to anticipate kind of this turnaround is really what develops in those three segments. And if you look at recession concerns, just for instance, 8 months ago when I asked a room full of people, do you think there's going to be a recession? Every hand was. Today, I just spoke to 75, 80 people. I asked, do you think there's going to be a recession? Not a single hand raised. Maybe there was a shy group, but that's the sentiment that I've been getting. That's a good key. And I think things are moving in the right direction. And once, as you mentioned before, once we get more of a signal from the Fed that this higher rate regime is probably coming to an end, that gives a little more certainty to the market to kind of move forward.
And what do you think? I mean, it sounds like as you think about like the kind of order of operations, like what has to happen first, like, certainly as rates rose, then delinquency standards tightened, as defaults rose, then delinquency standard tightened. Do you expect to see it kind of on the reverse of that coming out of it, where interest rates have to be cut, and then some time lag before you start to see maybe a little bit of easing of lending standards?
Yeah. So I think the two aren't necessarily. I think the lending standard piece is going to be more connected to what happens with delinquencies. And generally, when I speak with financial institutions, they're anticipating delinquencies to maybe peak at the back end of this year. Generally maybe middle of next year. And so, thinking about that piece, that kind of gets you going on the lending standard. I've looked at historical cycles. So last year I wrote a paper. It's called Timelines of Recession and Recovery, where I started looking at all these variables that are important for financial institutions, all kinds of labor market variables. And what happens in the 2 years leading up to a recessionary time period or period of stress? What happens during recession? What happens in the 2 years after? And so using that context, when I think about it, when I look at the lending standard piece, the lending standard tightening piece, if I anticipate that the delinquencies are probably going to peak the next year or so, if you look historically, kind of when the pace of lending standard peaks to when year-over-year credit growth for revolving consumer and non-revolving consumer credit kind of hits its bottom, it's about 5 to 6 quarters. So if you think that kind of peaked at the early part of 2020, first quarter of 2023, maybe first half of 2023, let's say it's actually Q2, then you're looking at maybe back end 2024, maybe for a credit bottom. And when I speak to our partners, they seem to share that same sentiment. And so I like to use these kind of timelines as a baseline view. For then you start bringing in other variables and say, well, maybe that's too early, maybe that's too late. But institutions are definitely thinking about that.
Are you seeing, or are you thinking about, is that spread across kind of the credit market, the type of consumer? And I think there's some evidence out there that like maybe prime or people who appear to be prime borrowers are more stressed than historical and are maybe performing worse than they were expected to perform in credit. Is that something that you're seeing in the data that you're looking at and the institutions you're speaking to as well?
Yeah, I think that's a really interesting question. So if you think about when institutions first, and the narrative has been that inflation, this cost of living challenges has really hit that kind of lower income consumer the most. And what you saw is when institutions rushed to tighten lending standards to kind of mitigate some of that risk, a lot of that tightening was focused in those subprime, near prime consumer segments, not so much on the prime. And you've definitely seen the more stress in that segment of the market. But I've been speaking with some, especially I hear this more in the fintech community, about stress maybe starting to creep up a little higher in the prime, near prime segment. And if I was looking at the roll rate, so the percentage of accounts for credit cards that are rolling into higher status of delinquency.
Sure.
When you look at the subprime segment, obviously it's been more of a steep angle, but recently, past couple of months, you've kind of seen it plateau out a little bit. Same for near prime. Near prime, not quite as steep, not quite as accelerated roll rate there, but it's still a little steep, but also started to flatten out. What you didn't see though is I look at the prime consumers. over the past 3 months, and that roll rate hasn't ticked over. It's just kind of gone up a little bit. And so I think there's some interesting dynamics there. One thing I'm looking at closely because of that is I'm looking at the role of rent costs. So, since the beginning of the pandemic, rent costs have gone up by like 30%. And a lot of times negative rent, if you miss your payment or you have an overdue balance, that's not always reported to the bureau.
Sure.
So it doesn't really reflect on your credit score, but that doesn't mean there's not stress there. Mm-hmm. And when you look at the segments, overall rent to income has gone, from roughly 30% to now like 38% of median rent to income, which is pretty high. Mm-hmm. But if you look at the segments, if you look at the renters that are renting at apartments that are like $1,500 to $2,000, their rental stress or their rate of increase for their negative payment behavior kind of peaked, last year, late 2022, but it's kind of moderating. The higher income buckets, so like $2,500 to like $3,000, we actually saw a much steeper increase in that. It's not quite as high overall, but steeper increase, and not much. We haven't really seen much improvement there. So to me, that's a little bit of sign that kind of hits on the point that there may be a little more stress in that prime segment, because I'm making an assumption that the people who are renting at higher levels or higher income probably higher score.
Are you seeing any difference in geography? Like I know that unemployment obviously is very low and continues to be low, but there have been very large layoffs, particularly across the tech sector, of relatively high paid employees. Are you seeing anything, or do you look at that geographically or by industry? Are you seeing any like pockets of stress that may explain that, or is it kind of too early to tell?
Well, so I think there's two parts. Going back to the rental piece, the Federal Reserve has done a study on this, that one, renters have seen a higher increase in credit card debt. Mm-hmm. And they also have higher delinquencies than homeowners, right? That makes sense. Homeowners benefited very greatly from the home valuation increases, while renters have just had to pay more.
Sure.
And that stress is even more concentrated in like those second home, vacation home communities, where you have people who've been living there their whole lives. And there's not a lot of housing stock, not a lot of rental units, and we have all this work from home people move in to the area, pushes up rental prices, home prices increase, and now if you're a renter there, you've been there for a long time, now you got to eat that cost, or you got to try to move. So that's one piece. The other piece, yes, I mean, definitely there's variation in unemployment rates across the country, but if broadly, if you look at the tech layoffs in particular, yes, they're significant within the market, but broadly as a whole, as a component of the overall labor market, it's still pretty small. And layoffs overall, still, if you look at the number of people who are filing for unemployment each week, it's still below pre-pandemic levels.
That's interesting. It definitely seems like a pretty unique economic environment, and with a variety of things that, as you said, last year everyone was confident we were heading to recession, and this year much less confident, and but certainly we can always be surprised. I think you had mentioned that some of the key factors really driving that growth, economic growth for the U.S. is consumer spending and consumers really driving that. Do you think that is going to continue for the foreseeable future, that we can expect to see that really being driven by the consumer spending?
I think so. Like, I don't think, consumers have been spending at a very strong clip. I don't think we're going to see the kind of strength of growth like we saw last year. I think consumers, though, still have the ability to spend. So if you look at wage growth by income quartile, so the Federal Reserve Bank of Atlanta puts out a good series on this, but basically you're looking at wage growth from the lowest income quartile to the highest, or roughly around 5% now. And whatever measure you take of inflation, wages are climbing faster.
Sure.
So wage growth is exceeding inflation. If you look at real disposable income, so incomes after tax adjusted for inflation, on a year-on-year basis, that continues to improve. And net worth for households is roughly 30% above pre-pandemic levels. You think about all the home value gains, you think about stock market gains, those components together tell you that the consumer, they have the ability to spend. I think the other piece to that then is the next question is like, well, are they, have they spent through their savings? Do they have the ability to finance that spending if they need to? And I think if you look at overall at the aggregate debt burdens when adjusted for the income increases we've seen over the last couple of years, it's basically pre-pandemic levels and historically fairly low. Now, there's definitely different pockets of stress you can pick out, but on aggregate, yeah.
Yeah, it is interesting that you see, and I think the impact of stimulus during the COVID years was probably greater than most of us expected it to be.
Yes.
And then there was a lot of anticipation of the student loan moratorium ending and consumers having to pay those back. And that really hasn't turned out to be a big impact either.
Right.
And we are still seeing consumers buy a lot of durables. So the durable purchases still remain really high, which I think is interesting. You'd mentioned those kind of high debt loads, like are people maxing out? It actually made me think of something, interesting that you had mentioned, like with rent increasing, that's kind of it's almost like a, off balance sheet, item. It's not on your credit report. So similar to, maybe the, buy now, pay later and some of the new fintech offerings that are not reported in the same way, maybe don't show up in a traditional debt to income, if the credit report is the source of that. Like, any thoughts on that maybe there's some hidden or obscured risks out there that we can't see right now?
Yeah, and I think underappreciated risk. I think the rental piece definitely bears watching. You look at the buy now pay later space. As an economist, and I think we're going to start getting more visibility into this. But whenever you can't see potential debt load that's it's opaque at the moment. You don't have a lot of visibility into it. That's always something that you have to worry about. The size of it, though, that and how much that may impact consumers. I think that's kind of speculation at this point. But you always have to keep that in mind when you're thinking about how much debt does consumers have. And looking at the overall aggregate debt loads, still manageable. If we look at kind of our internal data, looking at some of the debt to income for subprime, near prime, that's definitely risen faster. When I think of some of these challenges, the increase in debt, if the economy keeps doing well and, we don't have, wholesale layoffs and things like that, it's not that big of a problem, especially in the shorter term.
Sure.
Obviously, higher debt loads in an environment where you lose your job, you can't find another job, we're in recession, that's more problematic.
Sure. So what are your, as you think about like rent is increasing, but there's also some, obviously housing prices are still very high and interest rates for mortgages fluctuate a little bit, but remain high from what we've seen, not high historically, but high from what we've seen over the past several years. Do you think that there is as interest rates come down, do you think that there's a place where maybe home buying becomes more advantageous again, particularly for people who don't own a home? And then there's what about the people that are kind of locked into a very low fixed rate and feel like they can't move or can't upgrade or move up to a bigger home? Like just kind of general thoughts on the housing market today.
Yeah, so I think on the housing market, one, generally, I think we'll see once the Fed makes their first move, we start seeing interest rates come down a little bit. I think we will see a little bit of a pickup, not only just in home building, because home builders have really pulled back. A lot of affordability challenges, especially for first-time buyers in the new home market. But I think that we will see kind of a pickup in growth there, but not a lot because so many of the mortgages, to your point, are locked in. Like 80% of mortgages are locked in under, I think, 5% or something like that. So there's some room for improvement there, not a lot. Honestly, I don't feel that bad for people who locked in interest rates at 2.5% and seeing home values rise by 40%. So.
Yeah. It's really, it's not a bad problem to have, I guess. So it's like,
unless you need to move for work, if you've maybe, something like that.
That's true, unless you have to. But there are there have been a lot of articles like, oh no, people can't move because they have these great interest rates that locked in for 30 years in this home that was valued at 25% than today. It's like, well, that's a different kind of problem.
That's a good problem to have.
If you're going to have a housing problem. So I think that, we've talked about just the kind of forecast for the economy, your ideas for what your thoughts on what you think the Fed's going to do, and a credit growth, consumer behaviors. What are like some maybe key risks on the horizon? Things that, we've gone from expecting recession to now probably not at least imminently expecting one. But what's out there that could, I think, disrupt that economic stability or growth in the coming year? Things that could surprise us, not like a black swan event type issue, but something more typical or that could surprise us and derail where you think we're headed today.
Yeah. So one thing I always like to think about is why did economists and bankers and much of the industry get the recession call wrong last year? And for me, it's really two reasons. I think that by the way, at Experian, we did not forecast a recession last year, so we are on the good side of that call. But we overestimated the impact of rate hikes on the labor market. So Fed raises rates over 500 basis points, unemployment's basically where we were when we started, okay? And the second thing is we underestimated the resilience of the consumer to continue spending. And part of that is because the labor market remains so strong, but part of it is because consumers have just had a desire to keep spending, and the dynamics have shifted to where they can continue spending. But there's a lot of view that all of the excess savings has run out, consumers are going to fall off a cliff. That didn't happen. But when I think about that, I think about, okay, so in the back of my mind is, did we get the impact portion wrong, or is the timing wrong? So maybe these stresses that we thought would materialize last year are still on the horizon. So if you look back historically at the previous periods of rate hike cycles, you look at the 80s, the mid-90s, kind of pre-GFC period, pre-COVID, you look at when the Fed started raising rates to when they stopped raising rates, and in basically every instance, the unemployment rate was lowered, okay? We're not that far from when the Fed stopped raising rates, third quarter of last year. So, we've been cheering that, I think rightfully so. We should be pleased where the economy is, where the labor market is. But then you're like, well, is this really so special? Because then if you look 3 years after, or even if you go 2 years after, when the Fed stopped raising rates, in 4 out of those 5 cycles, we ended up in recession, unemployment rate rise. So one of the questions is this dynamic so special now? Have we avoided a recession? At the moment, I think the answer is yes. I don't see a recession this year, but always in the back of your mind, you have to maybe we got the timing of the impact wrong. Consumers too, consumers, they don't have as much cash on hand as they did last year. And so, but I still think that I think consumers can continue spending this year. I don't think it's going to be as much, but I think you always have to keep history. I think history can keep you humble in periods like this, and you always have to keep an eye on it.
No, I think that's a great point. And I think particularly there are a lot of, you mentioned the great financial crisis. There are a lot of people working and who are adults who are buying homes and starting families and who were not working during the great financial crisis. So they kind of have only seen a positive economic environment. And this is maybe the first time that they've really seen some stress out there. So, well, anyways, Joseph, thanks for being on the podcast.
Yeah,
great conversation. Love hearing about your thoughts on what we can look forward to in 2024.
Thank you so much. I appreciate the opportunity.